So this is a question that I've been getting the last couple of weeks, 3, 4, 5 weeks. And you start getting questions, or you start hearing some narratives in the news, and you want to start to deal with it. Because if I'm hearing it, you're probably hearing it. And as you know, investing is, one part the right knowledge and one part discipline, right? You can have all the right knowledge and not be disciplined, and the knowledge didn't do you any good. Or you can be really disciplined and end up in the wrong machine, and the machine can tear you up. So you want to be disciplined, but you also want to have the right parts. Well, the first half was to have the right mechanism or the right tool. We want to build a portfolio for you that is going to give you all the premiums that are available. And our portfolios are different, and that's what we're going to talk about tonight. We build a portfolio to capture premiums over the long haul, because that's the haul you have. And so I'm getting lots of different questions, and I'll read some of the questions that I have, and I don't want to oversimplify the questions I'm getting, but I want to have them culminate, and I'm thinking they'll culminate pretty well into this one. So the market is up. Why are my funds flat? That's a question that I've gotten from clients regularly this past 12 months. We're diversified among many asset classes. If the S&P is up so much, why am I still down? Do I own large U.S. companies still? I mean, if U.S. companies are up more than anything else, why am I still flat or not up as much? I've heard about a good company that's coming out with what sounds like a great new product. Can you take some of my IRA and move it into that particular stock? That was a question I received via email from a client who, after our conversation, hasn't taken that step yet. Hopefully won't. I'll explain more about that. My 401k account is beating my diversified fund. And then the email went on to say, now Evan, you helped me build that 401k account. And it's diversified too, so why should those two be performing differently? Why is my 401k performing differently than my existing portfolio with you? And then, shouldn't a diversified fund always beat the S&P 500? That's a question I received. Evan, I'm retiring in a few short years. I know diversification is good for the long haul, but I don't have the long haul left. I need to do better than diversification at this point. It's more of a comment than a question, but it's a comment that I've got to deal with, right? From a client who's looking at what's happening recently and saying, what should I do now? Now, as I distill all this down, and because of what you're about to find out, and the numbers that I'm about to give you, and probably what you already know from watching the news, it's the S&P that's up 15%. Nothing else is, right? So I think what everybody's asking me here is, should I go all in at this point? Is this the time to at least put a higher percentage of my money in the S&P 500? It did so well, right? And what I want to talk about is what happens. The home team did well. I looked up the RPI for the MSU basketball team. Anybody know where we're at in the RPI? It was better than I thought. Numbers? We're not in the top 25. You don't see that nice little number that tells you. We're 33 in the RPI right now. I thought we were worse. So the home team isn't doing so well in basketball. And I, for one, have an easy time of disliking the home team pretty badly, and I'm putting it nicely. But our football team, right? We had 2 losses, and guess where those 2 teams went? To the final game. That feels pretty good, right? If you're going to have 2 losses, those are the 2 teams you want in the final game. So the football team, I'm loving them, right? So the S&P 500 is easy to love. And what I want to do is kind of outline what it is we're dealing with here. And I'll go through this in a little while. I'm going to try to get it out of my way first so table number 1 over here can see. What we're dealing with are different asset classes, and we talked about the various asset classes in those final pie charts of the last presentation. You've got large, you've got small, you've got value companies, which are low price stocks, you've got growth companies, which are higher prices. And if you look at the returns on a $100,000 investment, January 1 this past year, 2014, and the numbers we have are through the end of November. We don't have December's numbers audited yet, so I'm just bringing you what I can today. So just about the whole year pretty much gives a good picture. The Russell 2000 value, which is the smallest 2,000 value companies in the United States, small companies in the value sector, there was a 1% return this past 11 months. The Russell 2000, which are small growth companies in the U.S., 2% return, roughly. And the S&P 500, 14 plus or minus % return. We like the home team. right? The home team is the team we hear about in the news every day. And this is a disparity. Do I want 1%? Do I want 2%? Or do I want 14%? Makes it pretty simple. Let's go 14, right? Now, we like international. We're going to invest globally, so let's look at the global picture. We take a look at the small international index, negative 4% last year. That was the return on small international this past 12 months. Large international index, negative 1%. And again, compare that to the S&P 500, which is 14 or 15%. Put these all together. S&P 500 index, 15%. If you look at the annual rate. The Russell 2000, small companies, 2.17%. Russell value, 1.5%. MSCI large and international small, negative 1 and negative 4.5. This is the facts. Now, we have 19 different asset classes. So over here, you'll see that in the U.S. we have large value, small value, micro. Internationally, we have emerging markets and developed markets. And in both emerging markets and developed markets, we have large value, small and small value. And then in the fixed income, we have everything from 1 year to intermediate to cash. Okay, so in the stock sectors, we have 13 different asset classes that we're representing. I'm giving you 5 here for illustrative purposes, but I'm choosing the 5 that make the point. Okay. Nothing more that I give you would be more than just some noise. We were just looking at the ones that are making the point. And so it's a valid question what folks are asking, and it's a valid desire if you're looking at how much of investing is emotions that we wish we would have been here all in January, right? Now, my goal of the night is this, that after I show you everything I'm going to show you, and given what you could have known in January this past year, you would have made the decision to be diversified and remain diversified on your own. Okay? For folks listening, same goal. So that, by conclusion, today, after we have this information, along with all the other information I'm going to give you, you would desire to make the same decision, which is be diversified and remain diversified going into the next unknown year. Okay, that's the goal of today, to fight those emotions and not allow this trap that's been set to grab you. Because this information is going to be produced in prospectuses and 401k plans, and it's going to be promoted as skill when it's just a fact, right? And what we already know is that small companies go up when large goes down, and large goes up when small goes down. This information on an annual basis is irrelevant to you as a long-term investor. And that's what I want to show you. That if you have the information we have, you'd make the decision we've made on your behalf if you were working on your own behalf. Okay, so that's what we're going to go through. Let's give some more info here. Now, we're going to be going through roughly a 25-year period of time. And we choose the 25-year period because Matson Money has been doing this for almost 25 years, 22 in some sectors and 23 when you look at others. And we're going to take it in chunks to show you how these ups are correlated with downs in other areas. So this is a period of time from 95 to 99. This is a 5-year period of time, and if you put $100,000 in an investment account, and that investment account was in emerging markets, large, then $100,000 would have been negative most of that 5-year period of time, and it would have ended right at the end up about 10% for the 5 years, so less than 2% per year. That would have been the emerging markets return. International small value. So we're looking at international developed markets, small value, that one sector. That would have grown $100,000 to $124,000 during that period of time. Okay? Large company value, international large value right here. It would have grown $100,000 to $182,000. That alone is not a bad return if you're watching returns. It's over 7-8% for a 5-year period. Now we have international large growth, about the same return. But you look at the S&P 500 during that period of time, and $100,000 would have been times 3.5 in 5 years. That is a huge return. 5 years' time, normally it takes what to double money? 10 years? 7 to 10 years. And a 7% rate of return, it takes 10 years to double money. At a 10% rate of return, it takes about 7 years to double money, 7.2. It's the rule of 72. So you can figure that. This is 3.5 timesing money in 5 years. That return is well into the 20% range per year compounding over that period of time. And had you been in the market during that entire period of time, you would have enjoyed that. I became an investor, as I said earlier, back in 94, 95. And I was pretty well diversified among 3 or 4, I can't remember, mutual funds in the American Funds family. American Funds, fine. 3 different mutual funds. It was a large U.S., small U.S., international large, and there was something else. I can't remember what I was in. And so I owned 3 of these represented, and I remember over the course of the 3 or 4 years that ensued, I was selling everything down here, and I was buying up here. And I was doing it based on track record. And the tech bubble, the internet came out when I graduated college, so I'm coming from way behind there. And the tech bubble was going crazy. The tech boom was going crazy. They didn't want to call it a bubble. Who wants to be so negative, right? But this thing was being created, and I was doubling down in my portfolio. And I was young. I didn't have, $100,000, but I had money, and I kept track of returns. I had an accounting major. I liked Excel, so I was keeping track of things. And I went all in here right about here. And I was selling this stuff that it was a dog. Year after year, 3 years in a row, I had data that said, this stuff is it's not where it's at for a 27-year-old kid, right? I can do better. And so I was there. But let's take a look at another period of time. We'll take a look at the next 7 years. The S&P 500, the next 7 years, grew money to $114,000. Now, where have you seen that number before? Do you remember that that's the gain on $100,000 in the last 12 months? Do you realize that the 6 years previous to that, in the S&P 500, there was really nothing there? Every bit of the gain here came essentially in the last 12 months on the S&P 500. They're the dog of the following 7-year period. No, I've got that wrong. I've got that wrong. So in this entire 7-year period, it came the same return as we've had in the last 1 year in the S&P 500. That makes sense? That's more accurate. If you look at the large company index, $100,000 grows to $155 over 7 years. The large value international index, $195,000 during that 7-year period. Emerging markets index, the same 5 indices we looked at on the previous slide, went to 312 for the next 7 years, and nearly $400,000 for the international small cap value. So this one on the previous slide was near the bottom and is now near the top. Now, if any of you are like me, you might be thinking something strategic here. What if I could have gotten all in on the S&P on the first slide and then smart enough to get out and all in on this one? Do you know what that number would be? It'd be $1.7 million on 100,000 over 12 years. That's a lot of cash. That's a huge return. But here's what actually happened for most people, because we said there are 30,000 mutual funds that you could choose from last year. There are over 1 billion investors who invest in the stock market. It's a statistical certainty, even worse, that someone probably actually did that. And maybe no money manager came close, or we'd all know his or her name, but some investor probably pulled that off and might be touting luck, or might have put it all back on red and spun the wheel one more time and lost it all, more than likely. When you get used to those kinds of returns, you're generally not happy with market returns afterwards. But what happened for most of us is like me, you start selling you sell away prudency pretty early. You start going in here. So by about 1998, 99, you're pretty much no longer diversified. And you didn't get this entire return because you didn't own it all the way. You kind of bought into it along the way. So by now you have the whole thing, and you didn't get the huge returns here, but you got some of it, right? So maybe your 100,000 is 200 or 250 by here. Then you owned it all the way through this period. And the advisor you worked with said, markets go up and they go down, be disciplined. So you were. And you lost part of your 250,000. It's down to 125, 130. And you waited until you had your money back. So you're back here. Maybe you've got your $200,000 back. And then you're starting to look over the fence again, because guess what you're starting to see? Right? You're starting to see some pretty hot returns up here. So you're ready to sell. and you're ready to buy in, and you missed half of what would have done that. And you went in and you got a little bit of that return, and then what happens in October of 2007, right? Bam, you're spanked again and you lose it again, and then you're done. You're saying, listen, I'm out. Almost all investors came through that 15, 12-year period of time with almost no gain. Those Dalbar numbers that cover 20-year periods, when they do it for those shorter, definite periods of time, the rates of return are 1 or 2%, and that is average. The average investor got 1 or 2% during those periods of time because they chased the sectors. They couldn't remain disciplined in various sectors the whole way. They chased after it. Because bubbles get created. This was last year in the S&P 500. Israel beat it. Thailand beat it. Turkey beat it. Philippines beat it. India beat it. Now, given this information, if you had walked in here saying, Evan, put me all into the S&P 500, wouldn't you rather me put you all in the India index? Now, you don't want that, right? We talked about the home team. India, I'm not so comfortable with, but it doubled money during, it doubled, not doubled money, more than doubled money if this kept going, but 29% is double the return of the U.S. market during that period. This would have been a better one if we're going to use that logic, right? But what's happening when these what's the right thing to do with sectors like this after a year like this? What's the right thing to do? Well, I got an email 2 days ago from a friend at Matson Money named Sabrina. She works there. She said, as part of our service to you, Matson Money reviews your clients' accounts for rebalancing each quarter. Just calm. Settle down, Evan. Everything's going to be okay. As a courtesy, I want to inform you that Matson Money will be rebalancing your client's account over the next days if needed. We're selling off a lot of those gains because there's a bubble being created in all these different areas. And we're going to sell off those gains, and guess what we're going to buy? International large, international small, because they were down, and guess how we're buying them? Buying them low. We're selling high, and we're buying low, and we're doing it because the model says we do it. We're not doing it because of any prediction about the future. We're doing it because over 40, 50, 60-year periods of time, we get premiums from small companies and value companies. But we only get them if we're there. We don't get them if we get you out hoping. Hope is not a strategy. Diversification and rebalancing is a strategy. So I got this email on the 20th. What is that? Tuesday, January 20th. Was that today? Yeah. I got it today. It's a long day. Another period of time, 1990 to 1999. This is a 10-year period of time. Fama French, this is the U.S. Large Value Index. You own that one. $100,000 during that 10-year period of time grew to 369. Very small U.S. companies. This is that CRISP 9 and 10 index. Small U.S. companies. 100 became 386. Small value companies, 100 became 448. And during this 10-year period of time, the S&P 500, 100,000 became 532. So here we have another 10-year period of time, or another chunk of time. It's including this entire decade now, not just half of it. And then you look at the very next decade with all of these, and that's the S&P 500. There is your large value. There's your small and small value US 592. Now, how many of you are going to come and tell me that that point in time was the time that, hey, let's do a flip-flop of these? Okay, we can't do that. But going in here, at the end of 99, like we would have in the end of 98, like we would have in the end of 97, we were selling off the inflated component, and we were buying the less inflated component. Now, something doesn't have to go down to be of less value. It's just relatively less than the others. It just didn't go up as much. So we then, if everything goes up but at different amounts, we still rebalance among the ones that went up more to the ones that went up relatively less. So we're going into this next period of time, which is a 14-year period of time, with a very different weight. We now own more of these companies because we sold off the gains here prior to this negative period. Not because we knew a negative period was coming, but because it was inflated. And when it was inflated, we sold it off and we redistributed. We rebalanced to your particular risk tolerance in the investments. And you can see that very clearly one's going up and one's either going up less well or coming down, and we're capitalizing on those by keeping your investment account weighted. These correlation numbers that we do, the correlation science on dissimilar price movement and whether one asset class moves in lockstep with another one or whether it has down years in different times is very important to you, especially in your retirement time. When you're retiring, if you took the S&P 500 as your retirement vehicle, you'd get around 10% during your retirement, and the ups and downs would be huge, right? But you can actually, you saw on that Harry Markowitz slide earlier, that you can actually get 10% with half the standard deviation of risk. You can get more income from a portfolio that's smooth in retirement than you can from a portfolio that's constantly going way up and way down, because it's those declines or those withdrawals you take when the account's down that really hurt you. And we can take away a lot of those dips through diversification. I'm going to keep going. This is the growth of $100,000 during that entire period now, 25 years, in the S&P 500. So now we have 25 years of the S&P 500. $100,000 becomes $946, almost $1 million. Now again, most investors would have done very well to do that. But Dalbar says that over 25 years, maybe they got $250,000 out of the deal. But the market would have done 10 times the money had you just remained disciplined in that one asset category. But there's a 25-year period that has all of these different asset categories involved. And where does the S&P 500 stack up among all of them? There's the 946. It's almost the worst asset class of all of them on the list. The only one that is vying for last place with it is Emerging Markets International, which toggles right around, not Emerging Markets, I'm sorry, Developed Markets International, which toggles right around the same 10%, 11% rate of return. Every other asset class on the stock side of the list beats this one. I'm not just showing you these four because some of them are worse. They're all better. These are the ones that are making the point, okay? And I can't put 15 up here. $1,042,000 on the large value. Small companies would have grown the same 100 to 1.6, and small value 2.65. So do you want me now, because of a good year, to sell this and go all in here? I don't think you want me to do that. I don't think that would be in your best interest in the short or long term. In the long term, because you're giving up long range, very good returns. In the short term, because these up and down price movements are mitigating risk for you. And in fact, a 1% or 1.5%, or some of you got in February, maybe a 0.25 or a negative 1% return for the past 12-month period, is a smoother ride than had you been in any one of those asset classes over the longer term. And you take any 3 or 4 year period, and especially the 15 to 20 year periods, and you're much, much better off remaining diversified and remaining rebalanced. And so given that information, I'm glad to answer questions. We will not chase the hot sectors, not with our own money and not with your money, for sure. And that's the presentation. So this can be personal. I've gotten a couple of questions from you personally, and I'd like to address those after I do a little bit of research. I'm glad to answer questions in a large group. This is great. I may not know the answer, but if I don't, I'll go get it and get back with you. So I can do that now. And then if you have a particular question, I'd like you to take the card out, and I want you to fill it out and give me some feedback. So whether you're a client now or whether you're not, fill out the card and give me some feedback. And then if you want to call, you can just say, if you're my client, just check the box. I want to talk to my coach. I think I'm going to skip that one, Liz. Thanks. And then if you're not yet a client and you'd like to talk, there is no cost or obligation for the next conversation. I'd love to have an opportunity to talk with you and go over some of these concepts and how they could make a difference for you. So glad you were here. Charlie, do we have a count on my listeners, or do we not know how to, we can't track how many? Okay, if you can let me know what that is sometime, that'd be great. I want to see if I can go from 2 to 3 or 2 to 4 this time. Thanks for listening, everyone out there in Cyberland. So thanks, everybody. Open to answer questions. Any thoughts or questions from anyone? Okay.
So people that don't have 20, 25 years
Mm-hmm.
to invest, what types of returns would they get for short term?
Yeah, so in the more we weight toward fixed income, the more we can tell you what those returns would be in the short term. But there's always a variance on the low end and the high end. So we have conservative clients who are 75% allocated to fixed income, and they're 15% in U.S. companies, and internationally they're 10%. And this would be a mix of assets that over the long haul, net of all fees, you should expect a 6 to 7% rate of return. And in the short run, you shouldn't see it go negative, although you could have a flat year. This year our conservative fund beat our aggressive fund. And that's going to happen. I mean, it certainly happened in 2008, right? 2008, the conservative fund almost didn't go down 3%. The aggressive fund went down 39%. That's what the market does every so often. So that can happen. But in a 5-year period, we can show you a range that in a conservative fund, if you take any 5-year period, you should expect to be plus 3-4% every year. In a 5-year period here, you could be flat for a 5-year period, but on average, you're going to be in the 12% range if you invite all those asset classes into what you're doing. So short run is always harder to predict. You take a 7 to 10 year, and you're going to be approaching that expected rate of return much more consistently. It's going to be better than that in the conservative end. If you're there 7, 8 years, you're on the aggressive end. You could have. It's very unlikely to go negative during that period. In a 3-year period, you're very likely to be worst case in the 3s, and you've seen 25, 30% per annum. So you're going to be in that range, and we just don't know where it could be. So, but if you have 10 plus years, you should consider a higher stock level in your portfolio. If you have 10 plus years to invest, you should remain here early on because that's where the return premiums are. Good question. Sorry, Gwen. Get right back to you.
A high school or college student, and you're working part-time, where do you suggest that they begin? Obviously, they don't have 100,000.
Right.
1,000 to even start investing.
High school, college student working part-time. I would generally take a look at this and say, let's go back to Dave Ramsey's steps. Let's make sure they have an emergency fund, because if you don't have one, you've got a credit card and you're going to end up using it. If you have a car loan, pay it off. If you have any credit card debt, get rid of it and get an emergency fund of $1,000, maybe $2,000 in cash. At that point, the Roth IRA is a good place because you can put the money in after tax, and high school students don't pay a lot of tax, and that money can grow forever. And I would go aggressive for $50 a month. If any of my clients have kids, I want you to get your kids in here to start giving us $50 a month. It does so much more than the investments even. It's a mindset. It gets them thinking past their nose a little bit. There's not much we do at age 18 that has ramifications into the future. This could be one thing that starts to get you to think long term, and so that's a really good thing to do. Most of the answer, though, is cash flow. And then once we're cash flow ready, then we start to put money in the investment account, and a good Roth IRA and an aggressively managed account is good. Great question. Peter.
Yeah, you showed a few slides up there, like a 5-year and 7 snapshot where those graphs flipped.
Mm-hmm.
If you were to show us a graph that really projected it out over a long period of time, is there a consistent cyclical pattern that repeats itself, say 5-year or 7-year pattern, or we can routinely or consistently see that kind of flipping action in those sectors?
What we can see routinely is a correlation number. So the correlation science is this: that if you look at the price movements of U.S. small versus international large or international large value, the correlation science between those two says, and I think the science between these is something like 0.450. So in other words, there's 0.450 of the time, less than half the time, these two asset classes are going to move in dissimilar directions. When that happens, there is no cyclical pattern. Have you ever heard of the Fibonacci charts, the wave theory of investing? You've heard that if you're an investor for 30 years. It was the rage in the 80s. They thought they could predict the waves and when the next wave, the downward wave, is coming because of this Fibonacci guy who came up with a set of patterns that then were going to come true. Harry Dent, we talk about him a lot in hopefully fair but negative ways. He's a Fibonacci guy. He likes to try to find those. You cannot find those correlations. Harry was wrong the last 6 times he tried to figure it out. What we can find pattern-wise is the more years we add to this doesn't deviate too much. There are, like international large and U.S. large, it's like 0.94. These two asset classes pretty much move in the same direction all the time. And they're both in our portfolio for good reasons, but you don't get any correlation benefits between those two. You do get them here, though. And these are the patterns that we're looking for, and we want to... The reason why we can be overweighted in small, I don't think I touched on that, the reason why those small sectors were -1 and -4 and our funds were still flat when the S&P 500 was so high is because our funds are overweighted here. We have much more money in these small company funds than we do in the large, and the reason we do that is because the returns are so much better, and we can beef those up without, because of these correlation numbers, we can beef up the small without increasing volatility too much. So we're using that science, we're kind of pressing up against the edge of livable volatility to get the very best returns and not have and not lose out on some of that benefit. Does that answer your question? We can't predict up and downs in any single class, but we can show you which asset classes are most advantageous to own together, and that becomes very clear the more numbers we add to it, the more years we add to it. Yep, good one. Anything else? Great. I'm glad you're here. Thanks for coming out. The food was great, so anyone listening can show up next time if we have this same thing. We may go back to the U Club here pretty quick. I do have something on the calendar with them next. It may be April. It's always nice having the whole big group together. But we have another seminar like this on the 28th, so if you know of anyone who could benefit from the answers to these questions, they'll get about the same hard sell that you got. So don't feel like you can't take a new person. We're not going to make them drink any colorful punch or red wine or white wine. You get your choice. So should be a good event for folks who, like you, felt like these topics were where you were at. So don't hesitate to invite others. And thanks for coming. Glad you were here.